My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Charles Rotblutt. Charles, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets, and what are you doing currently?
Certainly. I am a vice president with the American Association of Individual Investors. I'm also the editor of our monthly magazine, the AAII Journal. We're a nonprofit. Our focus is investor education and really helping individual investors overcome the various challenges they have in terms of trying to reach their financial goals. I've been working in finance. I'm starting to feel old, but I think I might be getting close to 30 years now. I'm starting to age myself, but true story, I actually started off in finance because I knew Microsoft Excel. This was in the early 1990s, and I was looking for a new job, and a CPA that was running a small firm analyzing privately held businesses needed somebody to come on as an analyst. And at the time, he thought it was easier to teach accounting than it was to teach finance. And so that's how I got my foothold in finance. Not hardly the traditional role, but it worked out well. From there, I went to work for Telescan Invest Tools. Those of you who've heard of Thinkorswim or used Thinkorswim, the Telescan basically, after a few mergers, it basically became part of TD Ameritrade. And so that was part of that. I worked for Curing Capital in Denver. It was a money management firm owned by Prudential UK, affiliated with Jackson National Life. Worked for Zacks Investment Research, working on the Zacks.com site as an analyst, also overseeing the content group for them. And then a little over 13 years ago, a fraternity brother of mine, who was the marketing director at the time at AAII, called me up, asked me to come join. This was the fall of 2009, which was not a good time to jump from one secure job into a new position, particularly in finance. But about 5 minutes into the interview, it felt like it could be a good place. And I've been there since. And to give you an idea, just real quick about the culture of AAII, we've got several people there who have been with the organization for 25, 30 years or longer. Very often when we hire someone to work at AAII, they tend to stay there a long time. And it's one of the appeals of working there is being around very collegial, very smart people, but also people that you get to build long-term working relationships with.
Okay, so let's talk about, I want to get right into the surveys, because that's often what's quoted, as I alluded to at the start of the Twitter space here. Explain to the audience, first of all, how big is the sample size of that survey? How is it conducted? And what is it currently saying about sentiment from an individual perspective?
Certainly. So we've done the survey since June 1987. It's a weekly survey. And over all these years, the questions never changed. It's basically over the next 6 months, I think stocks are going to be up, which is bullish. I think stocks are going to be down, which is bearish. Or I think stocks are going to be unchanged, which is neutral. The only thing that's changed with the survey is when it was first launched, there was no internet, there was no World Wide Web. So we used to send out postcards, and whatever postcard they got sent out in the middle of the week, and whatever postcards made it back to our office by Wednesday afternoon, that's how we tallied up the votes for the sentiment survey. Sometime in the mid-1990s, we switched it to being web-based, which is what it is now. It's open to any AAII member. They can come in anytime during the week, cast their votes. We do send out reminder emails, usually on Monday, to a small random group of AAII members, just reminding them. Typically, on an average week, we get around 330 responses. It does vary a little bit. This week was a little quiet. We had about 260 respondents. But we found over time, the amount of people taken the survey really doesn't have a big influence on the results. And so as of today, what we're seeing for our survey is we're seeing 29% of our responding members saying they're bullish, expecting stocks to go up. Our long-term average is actually 37.5%. So it's below average. And then you can really draw a line in the sand. Really, if you go back to January 2022, so January of last year, from that point on, we've seen bullish sentiment, optimism being below average almost continuously over that whole period. There might have been like about 2 weeks where it was above average. And I've looked at historical data, I've analyzed it. We've never seen this happen before. So it's been this ongoing lack of optimism. At the same time, we've seen pessimism largely stay above average. It's currently this week at 41.2%. And so that's actually unusually high. The historical average is 31%. But I will say, if you look at other surveys, you do generally see either pessimism or not a lot of optimism. Barron's, I think it was this weekend or last weekend, did a survey of money managers, and they found only about a third were actually optimistic, and I think a third were neutral. We've seen the Bank of America bull-bear spread. That's been staying pretty bearish over most weeks and most months. And then you can also look at the Trim Tabs Intelligent Investors survey of newsletter writers. That's come back, and we've seen optimism among newsletter writers improve. But when I looked at it about a week or two ago, it still wasn't really at high levels. So I think across the board, not just with our membership base, but across the board, you're seeing a lot of people who aren't that excited about stocks. And if you're a contrarian, you're a value investor, that's positive if you take a long-term view of the markets.
Okay, so there's a lot I want to dissect with this because I think there's a lot of interesting directions we can go. But first of all, do you find, or is there any evidence that would suggest that the sophistication level of the survey respondents has increased over time, over years, because of the democratization of finance, because of the availability of information, because of social networks, or is there a pretty sort of consistent level of just understanding on markets over time?
It's been pretty consistent. We survey our members, and annually, one of the questions we always ask them is to self-describe their level of investment knowledge. It's usually somewhere moderate. I have a good understanding of finance. I don't consider myself to be experts, but it's usually that kind of mid-level. I know what I'm doing, have a good understanding, but I wouldn't say I know everything. And that's been pretty steady along the way. So I've not seen any link between how well they understand the markets or even a greater understanding of the markets really influencing the results. If I were to say anything might be impacting results, might be increased political polarization, but even then, that would just simply be conjecture on my part, and I haven't really seen anything to actually separate that out either as a factor.
Yeah, it's funny because that's actually where I was going to go next. I would think that so just from my own observation, as somebody who's in the industry, a lot of you can correct me if I'm wrong with this, but demographically, there tend to be many more men that are interested in investing than women. There tend to be many more middle of the country tend to be investing more interested in investing than at the borders. And I say that because that does result, I think, in more of a lean towards conservative, Republican, and then maybe some emotional anger, frustration, whatever word you want to use, with when you're in a presidential cycle, which is where there's a Democrat in office. So I would assume that might just color some of the optimism or pessimism around stocks, even though in truth, whoever is in control of the White House largely doesn't affect stocks.
Yeah, absolutely. And it's every place I worked at, whether it was Zacks, whether it was Telescan, now at AAII, it tends to be older, more affluent men that tend to buy investment services at the individual level. It's just a demographic, and we can look at other organizations, and I've heard other organizations, newsletters, online companies say the same thing. That tends to be the demographic. Although I will say, when I actually talk to individual members, their political leanings cross the spectrum. But we do see this showing up in, say, a survey like Gallup, and anybody can go on Gallup's website and find this, where they ask periodically, what do you think of the economy? And there's always been a partisan spread. If Republicans in the White House are controlling Congress, Republicans think the economy is doing well. Democrats think it's doing lousy. Flip it. The Democrats think the economy is doing well. As a Democrat and the White House are optimistic. They're optimistic about the economy. Republicans are the opposite. You can find a Gallup poll. You can look and say at breakpoints like 2016 or 2020, when there's been a change in the White House, and there's just a stark changes in both political affiliations on how they view the economy. Even though the economy itself is not political, and it really doesn't care what your political leanings are, they do affect how people view the economy, and therefore the markets.
What about the number of respondents to the poll? Is there anything that you've seen that would suggest that there's maybe a contrarian aspect to bursts of people answering the survey versus, like you said, it being more on the kind of sleepier side? I say that almost like from a media perspective, right? So views on websites that are around markets tend to spike when you have high volatility. So I'm going to assume that there might be some element of that as well.
We really haven't seen that come through. I've not seen any indication. Not even in terms of responses or the direction of sentiment. Really, when we've seen probably the biggest swings and the most extreme values in sentiment have been among big market moves or near big market bottoms or peaks. We saw bear sentiment hit around 70% in March 2009, literally March 5th. So about 4 days before the market bottomed during the financial crisis.
That is hilarious,
yes,
by the way.
Yeah, it is. The timing's just, and then if you go the other direction, you look at bullish sentiment, it hit its all-time high in January 2000, right before the tech bubble burst. So we do see the extremes really being driven by the market and not by the number of responses.
But I think that's the key, and I think this is where we should focus a little bit of attention, which is that oftentimes you'll see on FinTwit people say, well, look at the percentage of people that are bearish, the market has to go up, or vice versa. And while it may be a high number, it's not an extreme number, right? I'm going to make the assumption that there's predictive power from a contrarian perspective only at the extremes, but most people are not aware of what those extremes are. Talk about just sort of from an investment strategy perspective, what are some of the levels, right, of that would help one identify what actually is extreme bear or extreme bull?
Certainly. So one of the things we actually track internally is we look at the standard deviation. So for those people listening who are not familiar with statistics, if you take a set of data, about 2/3 of it will fall like pretty close together. So almost like a hill forming up. But then at the both the left and right side, you'll have a small number of outliers. And a lot of people refer to those as the tails. And so when you look at those extreme values, basically if they're about 33%, we take the 33% outliers, so half on the upside, half on the bottom side. Those are numbers we look at, those standard numbers that are either one standard deviation above or below average. And so right now for bullish sentiment, one standard deviation below is 27%. And what we found over time, and that number does change over history, what we found is when bullish sentiment is more than one standard deviation below average, in this case, it's about 10 percentage points below the historical average. When it's below that, we've tend to found this as the market's actually defined as the S&P 500 tends to outperform over the next 6 to 12 months, and usually by a few percentage points. So a pretty good sized magnitude. Similarly, when we see bearish sentiment being too high or unusually high. In this case, it's about actually, for bear sentiment, so extreme value is about 40.9%. So again, about 10 percentage points above average. We tend to also see the S&P 500 outperform over the next 6 to 12 months. What's interesting is if you go the other direction and you see optimism being unusually high, the S&P 500 tends to underperform, but it doesn't drop. And the reason why is over the long term, stocks tend to rise. So if optimism gets too high, it doesn't mean you're necessarily going to have a big drop in the markets, but your returns will be lower. So it's really a case, if you want to be contrarian, really look for those scenarios where either people really aren't very optimistic or they're very bearish. And that's a sign you really want to consider buying. And it's not that sentiment itself causes a market reversal. It's usually a sign of other things. Perhaps valuations have gotten too cheap. In this case, we're seeing right now with interest rates rising, the economy is doing terribly. There's usually some reason that's driving people to be pessimistic, or at least not very optimistic about stocks. And those are usually catalysts for stocks to go up. So sentiment itself is really a symptom, not the cause, but it should be a prompt to take a look around, really get that broader mosaic of what's going on, and is this potentially a good time to buy stocks? So if you look right now, obviously a very steep interest rate tightening cycle. That's obviously last year really affected stocks, really affected bonds. And obviously now the big $64,000 question is, when does the Fed stop raising rates? And obviously we'll have to look past the current debt ceiling crisis as well. But you could see opportunities down the road, which might perhaps cause stocks to rebound. And what would be a prompt to look at something like that is the fact that you're seeing sentiment staying low, optimism staying low.
No, well, no, and actually, and that makes sense. I mean, overbought stays overbought for a while, whereas oversold, tends to not have the same duration, just because of the nature of, the way markets advance versus decline, and kind of concentrated movements. But I think another part that's worth emphasizing is that the survey, and I just shared it at the top of the Twitter space here in the Nest, is asking about the next 6 months.
Correct.
I think the dilemma that I see with social media, Twitter, is that people will reference this as if it's a contrarian indicator for what's going to happen in the next week or two.
Yes.
Right. So there's a timing mismatch, I'd argue. In other words, if people are using that as an argument to be bullish or bearish in the short term, 6 months may actually be long term for a lot of traders that you see on social media.
Yeah, and I think the big thing is if you're really looking at that short time horizon, it really comes down to almost daily headlines as to what's driving the market, whether it's economic news, whether it's company specific news. When you start getting over more 6 months, then you start looking at broader trends trying to drive things. But on any single week, the sentiment might not necessarily actually drive the markets. And in this case, we've seen bullish sentiment being below average for now an extended period of time, which is new, but we do see streaks of that. So it is important to take a longer term view. And when we've looked at performance, we have looked at those 6 and 12 month periods, not just a week, because a week is really, or even 2 weeks, so much of it is just headline noise driven. And obviously, if that's your focus in terms of time span, then you need to be thinking about those types of things, not something that might be a little bit longer looking indicator.
What about positioning? I mean, I always go back to this idea that one thing is to say that you're bullish or bearish, or do a response on a survey indicating you're optimistic or pessimistic, but nothing is, what are you actually positioned in? Have you done any trades based on that sentiment or the feeling? I would think if you're going to really be contrarian, it's more about actions taken, not words said.
Yeah, and absolutely. And it depends on how you're actually, what kind of strategy you're following. If you're a long-term investor, you might want to use this to look at your allocations. If you see optimism being really low, maybe take a look at your equity allocation. Ask yourself, is this below where I want it to be? Or do I have some room to actually move up a little bit? Cliff of Ness at hedge fund AQR has a great saying, sin a little. So if you're following a long-term strategy, maybe you stick to it, but you allow yourself a little wiggle room to perhaps be a little bit more tactical. But I think, obviously, if you have a shorter span, or perhaps you're just being more aggressive. And I think what I've seen people do over long term is they have a portion of their portfolio in index funds, long-term allocation strategies, and then they have a small portion of the portfolio that they're willing to be aggressive with. And certainly if you're a trader, perhaps, and you want to perhaps trade on sentiment, maybe that's even a small portion of what you're trading. And I think the case of position size, it really relates to what you're doing, what your strategy is. But even then, understanding, what is your main strategy and how much you're willing to allocate to a certain strategy. And in that case, you really have to consider what is the risk of wrong. And in the case of sentiment, it does tend to be a longer term indicator. So if you're trying to do it shorter term, then maybe you want to consider your portfolio. Maybe it's a smaller part of your portfolio, and it's okay to have some small bets, but obviously you always have to weigh the small bets versus your time and effort towards applying those. So positioning is really a matter of what your strategy is, how much of your portfolio you want to allocate towards being really aggressive, and then again, is that portion you're being aggressive, is that portion still large enough in terms of dollar amount to make it worth your while to actually be aggressive? So it's not necessarily a black and white question. It does require a little bit of thinking through and then being really rules-based with how you actually apply that.
Do you have any data that would suggest that the respondents to the survey tend to be more active in their portfolio or tend to have higher turnovers versus, kind of a general cross-section of the population? What's the sort of activity level of those that are responding?
Yeah, we do. We just survey our general members, so we don't know specifically which members are responding. So we don't have that level of detail from the people responding from the survey. In general, our members do tend to be long-term investors. They tend to be fundamental based. We do have a lot of people who are interested in applying technical analysis with fundamental analysis. We do have some active traders that are part of AAII, but we do tend to cater more towards long-term investors. That's our philosophy as an organization as well. So those type of people tend to naturally be attracted to us anyway.
So let's talk about broad allocation. So the survey is around the stock market. I'm going to assume there's no survey equivalent around the bond market, but the two have not exactly been that far off of each other, right? I mean, people have been bearish both stocks and bonds, especially given last year. Have you seen anything that would suggest that there's been kind of wholesale shifts in the stock bond kind of traditional 60-40 type of framework? I say that purely because the narrative that's out there is, why would anybody trade or invest in the stock market where you can get, a guaranteed 4%, type of yield? My response to that is always that people love to gamble, so why wouldn't they want to try and take a chance on stocks? But how do you think about allocations here and what some of the members of AAII are doing?
So we do a monthly asset allocation survey of our members. And we basically just ask them how much of their portfolio is allocated in stocks or stock funds, bonds or bond funds, or cash. And we've kept that survey unchanged since '87. And obviously, since then, you've had some newer asset classes and newer investments coming in, but we've kept it unchanged. So we have a continuous history. And the interesting thing is we have not seen big changes in the allocations, even though members have been bearish on the markets, or at least have not been optimistic at all. We've seen stock allocations stay in the 60% range, between about 60%, about 65%, pretty consistently. The historical average is about 61%. The bond allocations have been pretty steady, around 14, 15%. The historical average is around 16%. And in cash, it's fluctuated a little bit, but it's been pretty much high teens, mid 20 levels. So the allocations haven't changed much. And obviously last year was a very difficult year. There wasn't much room to hide unless you really went all cash. Even gold had a volatile, but it ended up being pretty flat last year. But I know a lot of people are now looking at, obviously I get these great yields in bonds. And the problem is that, yes, right now, even at the short end of the bond curve, you can buy a 4 or 6 month treasury bill and lock in 4 or 5% yields right now for the next 6 months, which is pretty good yield. But you don't get that capital appreciation from bonds. And so we've been encouraging our members to think long-term with their allocation, think what their goals are, because ultimately, if you have long-term goals to finance, then your big risk is not the short-term markets; it's inflation, and you need that allocation towards equity. But and so far, it seems like our members have been listening to that message and been paying attention to that, and letting their emotions run shorter term, but still thinking long term in terms of their allocation decisions.
Speaking of emotions, just given that you've been in the business for a while, do you get a sense that individuals are more emotional about markets than investment advisors, financial planners, or are investment advisors, financial planners just hyped up individuals under the fiduciary umbrella? I think it's more the latter, given the kinds of conferences I've spoken to and the way that people tend to, I think, frame things. But what are your thoughts on that?
Yeah, a couple of things. One, it's always easier to manage somebody else's money than your own. There's a certain level of emotional detachment when it's not your money on the line. But I think the other thing, though, too, is just, yeah, I do think everyone is emotional, and there's this whole talk about smart money versus dumb money. But I've sat in conferences, I'm sure you have too, where the people are supposed to be the quote unquote smart money. They can be emotional, they can be irrational. But I do think individuals, and it's just human nature that if you're left to yourself without someone trying to give you a slightly different view, you're going to be prone to making irrational decisions. And it's not every single person, but in general, one of the things I love pointing out when I talk about portfolio strategies is if you just need to take a step back and look at human history. The New York Stock Exchange was founded around 1790 or so. The first financial bubble we know of was the Dutch tulip bubble. That was around 1646. We know the first human settlement or civilization, town, whatever you want to call it, was Mesopotamia. That was like 10,000 BC. So we've had this long history of humans being on this planet with our brains evolving to really deal with natural dangers, tiger jumping out of savannah, droughts, floods, disease, wars, all this stuff that's, very dangerous to our health. That's what our brains evolved to actually deal with. The current structure of financial markets have only been around over a very short period of human history. So we're dealing with brains that evolved to deal with something very different than what we have right now. And it doesn't matter if you're a professional, if you're an individual, you're going to have this brain that's just not wired for markets, and that's going to drive their decisions. And that's why one of the things I'm a real big believer is just having a checklist. And I don't care if you're an advisor or an individual investor, just having it with a checklist or some rules-based process that you're going through. And some advisors and some professional investors and some individual investors are really good about going through that. But if you don't have one, you should create it. And then if you're an individual and you're talking to an advisor, I think it's really important just to ask them to explain their process. How are you going to set things up? How are you going to make decisions for me? And a good advisor should be able to explain that to you. And if they can't, and that's a sign perhaps they're a little bit more, instinct driven, off the cuff driven, and that should be a red flag. And again, just because you're professional does not make you immune from the same behavioral errors that will affect someone who is not a professional.
Okay, so since you talked about process, I'm going to assume a big part of AAII is emphasizing that one needs to actually have a process. It can't just be, finger in the air and invest or trade based on whichever way the wind is blowing. You have a very, I saw this PRISM terminology on the website. What is this PRISM wealth building process that you guys have built?
Certainly. So PRISM is a framework for aligning your investment goals with your investing decisions. And the whole process is really driven in the idea that your investing should be goals driven because everybody has a goal for money. Maybe you want to buy a house. Maybe you want to have a nice life in retirement. Maybe you want to give back to society or a congregation, or maybe just you want to have enough money to tell the rest of the world to go politely to go take a hike and do what you want.
If you're not going to say it, I'll say it. It's the whole fuck you money, right? It's like that's what you want.
Well, I just like to be family friendly.
I am definitely not family friendly on Twitter. Everybody sees my tweets.
So, but the whole idea behind this is that if you have a reason why you're investing, that should drive your investing decisions. And so, if you know what your goal is, and whether it is FU money, or or you just want to, you're looking at that new Tesla and you want to save up enough money to buy that Tesla in cash, that should drive the rest of your investment decisions. And the other component, obviously, is your ability to tolerate risk. And so when you look at goals, why do you start with goals? Well, you think about your goal. It's how much is this goal going to cost me? And when do I expect to reach this goal? So now all of a sudden you know two things. One, how much wealth you need to accumulate, and B, how much time you have to accumulate that wealth. And C, I should also add the other thing is, where are you going to spend it? Because you can have all the money in the world in stocks or crypto or gold or whatever your asset of choice is, but until the day you sell it, you actually don't have that cash to spend. And the day you sell, it's going to be dependent on whatever the price is of that asset. So that's why we set goals, to kind of set that framework. And then risk tolerance, it comes down to how much cash flow do you have from non-portfolio sources, whether you're working, if you're retired, it's Social Security, perhaps a pension. I'm sure the people that are younger are probably asking, what's a pension? In that group as well. But that source of money that you can take out of your portfolio without touching your portfolio actually gives you greater ability to tolerate volatility, fluctuations in the market. So that's the big components. You get those two things down, the rest is almost fill in the blank. So I will say there's one other component we always ask people is to consider the psychological component for handling market volatility. And I always encourage people to actually look at what they did. So take a look at last year's bear market. Take a look at what you did in March 2020 when the virus was spreading everywhere and the markets were in a tailspin. If you're older, go back and look at the financial crisis. And a lot of advisors like to give risk questionnaires. How will you react if your assets drop by 20% or 30%? The problem with those surveys is, depending on how you feel that day, will change your tolerance for risk. And literally, if it's sunny outside, if it's cloudy outside, that can affect your view of the markets. And I know that sounds a little unbelievable, but there have actually been studies showing that whether it's cloudy or sunny outside impacts the direction of the markets. Again, we have this mind that it's evolved not for the markets, but for very different scenarios. But so if you factor all those in, then it's really fill in the blank. So if you have a long-term horizon, you know market volatility doesn't phase you. You can take a very aggressive approach to allocation, and from there, it's just what's your ability to carry it out. If most of your assets are in a 401k, then you need to look at mutual funds because you're not going to have the ability to buy stocks. If most of the money's in an IRA or a brokerage account or a trading account, then maybe you have a preference for buying stocks or some other security. And once you do that, then it's a matter of just setting your rules for your assets. So if you want to buy mutual funds, well, what's going to drive your decision in terms of what mutual fund to buy, what to sell? Same with ETFs, same with stocks, etc. And finally, the M in PRISM is monitor, and we encourage people once a year to not just look over the portfolio, check their allocations, but we also ask them to just stop and take a look at their life and ask themselves what has changed. And the reason why it's really important is life happens and perhaps your goals are no longer the same. Perhaps you came into more wealth, which is great. Perhaps, you lost your job, or perhaps you got married or now you have kids. All these things might actually cause you to change your goals, might cause you to change your risk tolerance because perhaps you need to reallocate money that might have gone towards savings for other things, perhaps for diapers, for instance. And so that's the key thing. That a lot of times you do have strategies that talk about how to allocate, but they overlook that one important thing is, did something happen in my life that would cause me to actually reassess my goals or how I approach my investments? So, we have a simple checklist just asking really basic things. Has anything happened to your job? Has anything happened to your family? Has anything changed with your health? Are your goals still valid? And, just put a date on your calendar. January 1's a great time because it's New Year's to think about resolutions. But just take a step back and take a look at your portfolio. And even if you're not using a whole PRISM process, it's just a good idea to just once a year take a step back and ask yourself, am I good with everything? Has anything changed in my life? And if so, you want to go back and reevaluate your investment strategy and ask yourself what you need to change. Obviously, an advisor can walk you through this, and a good advisor should be doing those yearly check-ins. But it's certainly something people can just do by themselves pretty easily. And just write it down, and maybe the next year you look at what you wrote down the year previously, and then look at where you're at now and just ask yourself, what has changed in my views? What has changed in my life?
I think that's very, very well articulated. Okay, now, again, we're talking about allocations. You and I both know asset allocation is the key to everything, right? I always go back to beat the average, you have to choose the right average, right? It's less about security selection, more about the kind of broad allocation. But I'm going to assume that a lot of the AAII members they want to play with individual stocks. Yes, you can talk about asset allocation, show the studies, but people love those Teslas of the world and stories of the world, right? And the volatility that comes with that. Talk about how you educate members around stock screening for those that are adamant about that way of approaching their portfolios.
Yeah, so we have about 60 stock screens on our website, and we do talk about them. And I've been a big proponent of stock screening long before I came to AAII. For those people who are not familiar with stock screens, just to step back, a stock screen is just basically a database filter. You're basically telling a database, okay, give me stocks, and perhaps you want stocks. I want stocks with a P below 15. I want the stock to have outperformed the market over the last 52 weeks. And I want the company to have a high return equity. The screen will just go out and find stocks with those exact criteria. And so the nice thing about screens is that if you have a certain style of investing, perhaps you're a value investor, a momentum investor, or even if you're a trader, it will find you stocks with a specific traits. And so what we try to educate people about is not only how to use screens, but understanding what actually is the screen looking for and what's the logic behind it. Because the great thing about screens is they're completely objective. The bad thing about screens is that whoever created the screen is putting in their own biases into this criteria. So the computer knows nothing other than I'm supposed to look for these specific traits. But so we spent a lot of time trying to explain the logic behind the screen. What is this person looking for with our guru screens? We have screens based on Warren Buffett, Jim O'Shaughnessy, David Dreaman, William O'Neill of IBD fame. But we also have, we call them factor screens, screens that are looking, say, perhaps for a low PE, a high return equity. Earnings, actually one of our best performing screens is earnings estimate revisions. We look for stocks that actually have positive revisions in earnings estimates, and those are some of our best long-term performing screens. But we try to educate people, okay, what is the screen looking for? Because it's really important to understand what is the philosophy behind the screen? What is it looking for? Why is it looking for that type of criteria? Because all that allows you to actually set up your sell decisions. And your sell decisions at a very high level should just be the opposite of your buy decisions. For instance, one of our longest running model portfolios is our model shadow stock portfolio. It's a microcap value strategy. It looks for stocks with very low price to book ratios, very low market capitalization between $30 and $300 million, and requires them to be profitable. Our sell rules are simply, it's no longer a microcap stock. Its price to book ratio is no longer really, really cheap, or the company has been unprofitable. Simple as that. And so if you have a screen that perhaps looks for 2 or 3 indicators, your sell rule should just be the exact opposite of that screen. So maybe you are looking, I want a stock with a relative strength score of 80%. And if you're a true momentum investor, you probably want to set that score at 60%, so that your stock's, top quintile performance. But then, if the stock's, price performance becomes more about average, that might be your sign to get out of the stock. So that's one of the things we try to educate investors. And when we talk about screens, is not only how to use the screen, but what is the screen looking for, so they understand what might cause them to get out of a stock. But I think it's also important to just understand why stock's passing the screen, because when it doesn't pass the screen, does not necessarily mean it's a sell. It may just mean that one characteristic is just a little bit below the screening criteria. But if you understand the philosophy of the screen, you might realize you might want to hold on to the stock. And the reason why I bring this up is going back to earnings estimate revisions. Analysts tend to raise their estimates typically after companies report earnings. So company beats, they surprise, they raise guidance. Analysts raise their estimates. And so obviously we're getting near the end of earnings seasons right now. Well, now if you go fast forward and maybe you get to the end of June, early July, the company's about to report earnings. They're not saying very much. The analysts might not be making any changes. So all of a sudden, the stock is no longer passing the earnings estimate revision screen. And so you might think, oh, I want to sell the stock. Well, the reality is it's not that the stock's suddenly become a bad stock. It's just that analysts have become dormant. And we know that we tend to see positive surprises in their earnings estimate revisions. We tend to see this happening over and over and over till they don't. So it might be the case that if you waited a few more weeks, say to late July, early August, the company may report again issue a positive surprise, and analysts might raise their earnings estimates, again, therefore causing the stock to pass the screen. So this is why we try to educate our members on what the screen does, what the philosophy is, so they can kind of get a sense of this nuance and understand how the screen works and what it's looking for and why it's looking for that specific criteria.
Yeah, I love that. I always go back to that line I've used many times. Amateurs look to the right of the equal sign, pros look to the left. So you've got to look to the left to see what's driving the output. I'm going to, again, I think correctly assume on this that screens are only as good as the cycle that you're in that favors the screen. Right. So I always go back to that point. Cycles drive everything. So certain cycles value works better than growth. Certain cycles, cancel might work better than others. Is there anything that would suggest that the popularity of a particular screen is indicative of the current cycle we're in, or maybe from a contrarian perspective, the end of the current cycle?
I think probably more indicative of the cycle that we're in. When we see value doing really well, one of our screens is our Joseph Piotrowski screen. And when value was doing well, really prior to the latter part of the last decade, we saw a lot of people using it, a lot of people were talking about it. And then this strategy looks for very cheap stocks. And Joseph Piotrowski has what's known as an F score. And it's basically a 9-point scale for assessing a stock's fundamental quality. We saw a lot of people using that. And so we do see people tend to be performance chasing with the screens. And it's that age-old thing that if something's doing well, you'll see people gravitate towards it. And until it doesn't do well, then obviously everyone jumps out of it. So we do see that for our screens too. When we see usage of it or talk among our members, there is always that focus on what's doing well now. And as you said, certain screen philosophies are better for certain type of markets. And even in the case of value versus growth, anyone can call it a chart, take a look at, say, the Russell 1000 growth, Russell 1000 value, draw a line right about early March, and you'll see a big switch in performance between the two. That was right when you had the banking crisis happen, when Silicon Valley Bank crashed. All of a sudden, you start seeing growth doing really well, Why? Because everyone started assuming the Fed was getting close to pausing its interest rates. And so when you look at screens, it might be a situation that afterwards you start seeing growth screens suddenly doing well and value screens not doing so well because there was that change in market conditions.
For those who want to learn more about AAII and get maybe engaged and involved, any kind of suggestions or recommendations? Obviously, they can go to the website, but anything else that people should consider?
Yeah, I think obviously going to our website, AAII.com. We do have low-cost trials for that. But I think our whole goal is education. So we do have a lot of tools, our screening tools. We have portfolio analysis tools. But I think the other thing we have, because our focus is really educating investors, going through the journal, and obviously I'm biased because I'm the editor of it, and so I'll give myself a shameless plug here. But we have literally over 40 years of content on our site, really covering all aspects of investing, not just stock selection, but fund selection, portfolio allocation, retirement withdrawals, how to save. And so I think one of the things I would, people who want to learn more and have interest in a specific topic, don't be afraid to use a search function. Use the search function on our website to just go search around and take a look at it. I also, my investor update too, I comment a lot about more current market type stuff. I'll usually post it to every Thursday to Twitter. I'm actually talking about I bonds right now. Today, it'll be up on our website later tonight, aai.com/investor-update. Basically, what people should do with the I bonds, those people who bought them last year when they had that juicy yield of 9.6%, and walking through some of the investment decision. But that's wide open. There's no paywall to read it. So if somebody wants to kind of get a taste of some of the things they do and some of the things that I write about, that's one thing they certainly can look at. And as I said, I will have a link to it on my Twitter feed sometime this evening.
It's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Charles here on Twitter. Doing another Twitter space in about 6 minutes. Stay tuned for that. Thank you, Charles. Really appreciate it.
Thank you. It's a great conversation.
Cheers, everybody.